Brown Family Wealth quarterly update. While we wait for people to file in here, we would love for you guys to ponder this question for just a minute.
But what is one personal goal you are working towards? Feel free to put it in the chat. This is an interactive session, so we'd love for you guys, as you have questions about the slides we're discussing today or the topics, enter your questions in the chat. But we're going to start with this one today. So, what is one personal goal you're working towards? We'll revisit some of the responses as we go through. But Katie, why don't we start off with a quick introduction? So, Morton Brown Family Wealth, we always have a lot of new faces here and people who are joining us for the first time. We're on a mission to revolutionize the way people plan and invest for the future. So our job is to transform complexity and empower clients to experience financial confidence reimagined. So our aspiration is to be a catalyst for change in the way financial advice is delivered as trusted advisors, thought leaders, and community partners. And this is part of the thought leadership side. So, again, as people join in today, we want you to enter in what is one personal goal that you're working towards. Put it in the chat. Now, Katie, we're going to start off today with something a little bit different. This is like live podcasting, right? So, which is what we always wanted to do, right? So we're going to start with the topic of decision making and decision making as it relates to finance, specifically winning decisions, the decisions that win the game. This is going to be our first tennis reference on the quarterly market update, right?
Love it.
Love it. So we're going to tee this off with a quote. I don't know if anyone saw the presentation that Roger Federer made. It was the Dartmouth commencement speech, and it went viral earlier this spring. And so there was a quote here, and I'm going to use this to tee up our conversation today. Roger Federer said that in the 1,526 singles matches I played in my career, I won almost 80%. What percentage of points do you think I won in those matches? Only 54%. When you lose every second point on average, you learn not to dwell on every shot. Katie, what's your take on that as it relates to our decision making as investors?
That was a powerful statement, powerful set of numbers, I think. Before I relate it back to investing, I do play tennis myself, and I grew up playing competitive tennis. And I think that framing, that mindset, that acknowledgement, when you're out on the court, you are constantly trying to get yourself ready for the next point, trying to let go of the last one, but to put it in that perspective of you're going to lose almost every other point, or you're going to lose, close to 50%, and you can still win the match. You can still, progress in your goals. And I think when it comes to investing, I think having that humility is so important. Nobody's going to get it 100% correct. And as much as you can, train your mind and your brain to say, okay, that's in the past. Now, how do we move forward and make a good decision forward? Not necessarily, I think where investing gets challenging is you get so wrapped up, well, anything, you get so wrapped up in what happened before that you want to catch up and you want to make up ground, and you kind of try to fight through it. So
it's the question I would ask anybody who is making the decision between being a trader and being a long-term investor. Because if you're going to be a trader, are you ready to lose every other point? It's really going to feel like that. Like you're going to have days like yesterday. Yesterday was a poor day in the markets, just anecdotally. Are you going to acknowledge that there are going to be days like that, and it's not going to distract you from the long-term win? And that's what Federer said. Long-term, I knew I was winning. But in the near term, you could convince yourself, oh my gosh, I'm losing every other point. And we hear that as we talk to investors a lot.
Yeah. I think where it shows up oftentimes is in sort of the anxiety. If you allow yourself to, like you said, look at a day like yesterday and feel as if I have to catch up now because I had a really bad day, like you kind of get pulled into excess sort of anxiety, and almost, once again, bringing it back to tennis, I think one of the things that my coach constantly kind of drilled into me was slow down, take a breath. It's going to be okay. Look forward. Don't look backward. You constantly have to kind of do that, just
Mhm.
that slow down and recognize you can't fight your way through that better outcome necessarily.
Yes, yes. And there was a book, I'm going to forget the name of the book, Charlie Ellis, famous investing book, and he talked about winning tennis and the analogies there. And in winning tennis, in professional tennis, you're just trying to win more points than your opponent wins. Amateur tennis, you beat yourself. And that's the part when you get consumed by the day to day, you make decisions that end up being self-defeating and saying, I'm gonna, get all in when the going is good, get all out when things are bad. And you end up, it's those, self-inflicted wounds that end up hurting you.
Yeah. And I think there's a lot of chasing that happens too. Because
Mhm.
you see somebody else's success doing something a particular way, and to almost try to chase it and say, I'm going to do that too. I'm going to buy that stock that's been running up. I'm going to participate in that when maybe you don't need to. So,
Yeah, yeah. Playing someone else's game. That's a,
yep.
that's another sports, and there's infinite sports analogies. But it's funny because we talk often about how a lot of the things that we would never do in life we choose to do in investing, and it just doesn't make sense. And just playing someone else's game or something that we're not adept with, and trying to do that in investing, it rarely works. So we just want to talk this morning about just some parallels and some. These sessions are designed not just to inform you, but how to think about investing in the markets. So right now we're going to shift over, and we had asked the question before, what is one personal goal you're working towards? And interesting, in the comment thread, a lot of it has to do with physical health, brain health, and just longevity. And I think that's a really important thing, as we talk about, it's funny, no one says have the biggest pile of money. It's all about
Yeah.
just what are the things that allow us to enjoy the wealth that we've accumulated, right?
Right. Quality of life.
Quality of life.
Absolutely.
All
And
right.
each decision that you make along the way helps to contribute to that quality of life. How much you decide to get kind of pulled into, pulled back into those previous decisions, or how much you decide to look forward and say, all right, I'm going to make the best decision possible for that quality of life aspect, not necessarily to catch up on something maybe that just happened.
Yeah. Yeah. All right, we're going to pull in Sean. If you want to jump on the screen, we're going to pull in Sean Roth, one of the newest members of our team. He's going to start us off on the slides today, just talking about what's been happening in the markets. So, Sean, let's talk first about some positive signals and reasons for concern coming out of the second quarter of 2024.
Yep. So as always, we always want to take a balanced approach to any news we read, not reacting too positively or too negatively. So, first off, on the positive side, unemployment, has been less than 4% for 30 consecutive months. In June, it actually bumped up to 4.1%. GDP growth in the U.S. is still, tracking very nicely. The May CPI report was a step, in the right direction as we try to fight inflation. And even as the S&P's, highly concentrated in the top 10 stocks, those top 10 stocks and are still delivering, their earnings on average. So those are some positive signals. Some of the reasons for concern, on the other hand, as we know, the consumer drives 2/3 of the GDP, and there have been elevated delinquencies in credit card and auto loans. Also, inflation remains elevated. And we can expect kind of a bumpier road as the Fed targets 2% inflation levels. Then also the top 10 stocks in the S&P are highly concentrated. That's where the vast majority of returns in the second quarter came from, was the infotech sector.
I think one of the things that always comes up when we talk about the positive signals and reasons for concern is there can be a disconnect. There can be a disconnect between what we see and in real time in the markets and what's actually happening in the economy. So a lot of times it's about not whether things are good or bad, or whether they're getting better or getting worse. And to the extent things might be really good and maybe teetering a little bit, that's why you have bonds. That's why we have fixed income and are diversified. So, Sean, this is one of our favorite charts. Why don't you talk about the Callan chart?
Yeah, so this is the Callan chart. It goes over all investable asset categories, and it goes by ranking over the last 20 years. One thing, Dennis, we talk about is we always like to, ask clients to find a pattern. And I think that the thing there is there absolutely is no pattern. For example, you can look at, real estate and cash, 1 year can be at the bottom, the next year and in the year, they're near the top. And, then cash is right back, near the bottom. I think, the only the only certainty is long-term volatility, which is why we believe that, asset allocation is really important to your portfolio.
It is interesting. There's no pattern, but there are definitely some different trends in there. Like, we know the riskier asset classes will often find at the top or the bottom. So emerging markets, represented here in orange, is often, you'll find it at the extremes more often than some of the other asset classes. And we know in general, the markets move up. And so at the top, we have primarily, equity asset classes. So large cap stocks over the last 20 years here, large cap stocks, small cap stocks, emerging markets, and real estate have all been up at the top 20% of the time each, roughly. That's not to say that's always going to happen, but 75% of the time, or 80% of the time in this case, we have, the equity markets. And then the other 20%, we know we're going to have those down years. So there are a couple of years where cash outperforms or bonds outperform. And so we kind of know some trends. We just never know exactly who that top runner, that front runner is going to be. So it is fascinating to look at.
Absolutely. Absolutely. All right, let's talk about what expectations were for this year. Sean, is the Fed doing what they said they were going to do?
So as we all heard, in the beginning of the year, the Fed was talking around 6 rate cuts. And then, by the end of the first quarter, that went down to 3. And, now at the end of the second quarter, I believe we're expecting, 1 rate cut. And the Fed openly states that they are data dependent and inflation is still above target. And, there's still solid growth, but they're in no hurry to reduce the rates prematurely. And it's almost like the Fed, hasn't decided, what they're going to do. And we can't say for certain when the Fed will cut rates or by how much. But, one thing we do know is that it's really important to know how the markets, specifically the fixed income and the bond market, react to interest rate cuts. And that's actually what Cody's going to talk to us about next.
Cody wants to take it from there.
All right. So as Sean was just discussing, going over the expectations for the Fed so far this year and how it has changed, especially going into the second half of this year. What we're looking at here is going over the global bond returns for Q2, year to date, and then also the last 12 months. One thing that I think is important to point out is year to date, we started the year, the 10-year Treasury was right around 3.9%, even though obviously the Fed did not raise interest rates this year. The market has bumped that up to 4.25 as of close yesterday. And the reason for that is kind of just what Sean just went over. The expectations for the Fed to cut rates has obviously dropped from potentially 6 times down to 1 or 2 times this year, depending obviously how inflation does over the next couple of months. But one thing to point out is, as we were talking about earlier, and Dennis and Katie were talking about some of the analogies from tennis, focusing on the long term. So if we look at the last 12 months, fixed income has actually done very well, even though the Fed has not cut interest rates. And there's a couple reasons for that, and we'll go through that in a little more detail. But just look at the last 12-year returns for the different fixed income asset classes. Even though the Fed has not raised or cut interest rates, we're positive in every single asset class. Whether that's short-term, intermediate term, treasury bonds, or corporate bonds, we've been positive over the last year.
You know what, Cody, I know, I can't remember if it was last session or 2 sessions ago when we do these updates, we've talked about the best predictor of future performance of bonds is the yield from like this point forward.
Yeah.
And it was right around 12 months ago that the Fed paused and said, we're done raising interest rates. And, time stamped that yield then, and you're looking at the performance right now. It's exactly pretty close to it.
And this chart kind of goes, we have a couple charts on that. So this chart kind of goes over that. And I know we brought up this chart before too, about don't being caught in the cash trap. So right now, since the Fed rate is right around 5.5%, you can actually pick up some yield on high yield savings, money market, and that's fine for short-term money. But when you're looking 12 months out or potentially even longer term, now is a good time to put some of that money to work, obviously in fixed income. And as you were saying, Dennis, one of the reasons for that is we're actually able to get some yield right now. So what this chart is looking at is over the last 6 rate hike cycles, what the peak CD rate, and then the next 12 months, what's the return you got from fixed income, which here they use the benchmark of the US Ag, the S&P 500, or a 60-40 portfolio. So if we look back to just September of last year, fixed income, as we just showed on that last slide, is up around 6%. Right here, the blue, dark blue graph. The S&P 500 is up almost 30% since the Fed stopped raising interest rates last year. And a 60-40 portfolio, obviously depending on how much is in US stocks, international, and depending on the fixed income tilt, potentially is up around 20%. So since the Fed has stopped raising interest rates last year, we've had a very strong rally, both in international stocks, US fixed income, international fixed income. It's been a broad rally, which is good.
Katie, you know what we've been talking about for years that's actually become a little inside joke is, in general, and if you have questions about bonds, please ask them. People don't quite understand how bonds work. They know they need them, but don't always understand how fixed income works in the portfolio. I've spent a lot of time in client meetings explaining that in the last year, to the point where I've started to be referred to as a bond guy by some certain clients. But I think it's really
Refer to
important.
yourself as a bond guy once.
I did refer to myself as a bond guy. Self-glossing is a thing. That's all right. That's all right. We're still working on your nickname, by the way. We're not there yet.
All right, continue. Sorry.
But it's got nothing to do with bonds. That's all. But it's we all know that bonds are an important part of the portfolio, especially as you approach retirement, especially as you're trying to manage volatility. And I think just understanding how they work is a really important part of this conversation. That's why we're leading with it today, because when interest rates go up, bonds go down. When interest rates, go down, bonds go up. And, potential declining interest rate environment could be a very important development for people who have bonds as part of their strategy.
Yep.
I have to say it's kind of a silly little thing, and you guys know this about me. I'm definitely a long view person. I'd like to kind of take the path of least resistance when it comes to investing. I don't like to get too cute, but I feel like I'm really fascinated by this fixed income market. I mean, coming off of 40 years of rates on a downward trend, and then all of a sudden, getting up into a real sizable rate hike cycle, and now seeing what the aftermath of that is going to be like, and the impact of that, and the opportunity of that. I'm just really fascinated to kind of follow along, I think, on the fixed income side.
I agree. Good point.
That is a good point. So this chart is going over the starting yield, and this is looking back to the 1970s, so over 50 years of data. Looking at what we're looking at on the bottom side here is the starting yield. So the yield you're getting on fixed income. On the left side is the annual 5-year returns that you got, depending on where the starting yield was. So you can see right now, we're right here around 5.2%. So what our expectation should be going forward potentially should be a annual return of around 5.2% over the next 5 years for fixed income. Obviously, some years potentially could be a little higher, some years could be a little less. But what this is showing is, depending on what the starting yield is, normally your 5-year analyzed returns are very close to what that starting yield is. And as this is showing, you can see down here in 2010 to 2022, before the Fed raised interest rates, the return you were getting from fixed income was 1 to 3%, and that's what the annual return was. But now that we're back up to 5%, we should expect annual returns between 5 to 6%, depending on your duration and what fixed income you're into. But that's also why it's important, obviously, to work with a financial advisor and making sure you have that right allocation of fixed income and stocks.
Yeah, this strikes me as a generational chart. It's like, where were you at this season of life? And for people who were buying their first homes in the early 80s, or people who were starting investing in the 2010s, it shows you just what disparate environments we've been in over the last 40 years. And that it necessitates change. You have to migrate a little bit. I think that's where we are. We're at a really an inflection point of how to invest, how to get income, how to find growth. It's very interesting.
Yeah. And another
I think one of
important
the big
thing
differences. Sorry,
go ahead,
Cody.
Katie. Go ahead.
And so one of the things, kind of going back to this fascination with the fixed income market, is that you're right, Cody. We sat in that orange range for a long time, and really a lot of the expectation for fixed income then was to provide that stability within the portfolio, so that when we have a lot of volatility on the stock side, we have some more stability in bonds. But as we migrate further up this trend line, we're getting the stability, but now we're also getting some legitimate contribution to the portfolio and the returns, and a little bit more, nothing's ever certain, but a little bit more predictability around income generation that can really help support. So I think factoring both of those things in is interesting for this environment going forward.
And as we transition to the stock conversation, we called it the TINA trade. And Katie, for most of our professional careers, it's been, there is no alternative to investing in stocks because you couldn't get yield anywhere. Well, now, we can be diversified. So let's talk about the stock market a little bit.
Good point. So this is, and first of all, I want to say sorry if the graphic isn't the best for you guys. There's a little glitch in the system, so the PowerPoint didn't upload completely, but we will follow up with the PowerPoint if you want to look at the slides afterwards to see the details. But we're looking at, Q2 for 2024 year to date in the last 12 months. The dark blue is the US large cap. So obviously that has had, very strong returns over the last 12 months, up almost 24%, year to date up 14%. But then also look at some of the other areas. Emerging market is up 7% year to date, just in Q2, up 5%. Small cap, it did have a little bit of a sell-off in Q2. One thing we want to say here is what we're looking at on the left side is obviously, year to date at the end of June. On the right side, we did a chart based on July 1st to as of close yesterday. And sorry, it's probably hard to read this graph, but the purple line is US small cap, which is up a little over 8% since the beginning of June. And the orange line is US large cap, the S&P 500. That is actually negative so far in the month of July. Obviously looking at a very, short time frame, but this is why it's important to have diversification outside of just the largest, 7 stocks that everybody's talking about inside of the US. One other chart we want to go over, and we brought up this chart in the fall of 2022. And what this is looking at is the PE ratio. So the valuation that currently, if you bought the S&P 500, that's what you would be paying for the earnings that the companies are turning inside of the benchmark. The yellow dot on the left chart and on the right chart is where we were in the fall of 2022. So the cheaper the valuation is, which is on the bottom axis, shows that on a one year basis, you should expect positive returns. Obviously, there's some years negative, but then over a 5-year basis, you should expect higher annual returns, which if you just eyeline over to the left side, potentially around 10% on an annual basis over the next 5 years. Where we're at currently, you can see on a 1 year basis, obviously there's very strong years, and so far year to date, it's been very strong. On a 5-year basis, this may be, pointing out that maybe we have to lower our expectations. We're not going to potentially have, the 10 to 15% annual returns that we've seen since 2008, 2009. That's not saying to obviously get out of the stock market or anything, and that could obviously change too. So if the companies beat their estimates, which we're going into earnings season right now, the valuation may actually not be as high as what we're showing here. This is just based on what the price is for the earnings now. But if the companies continue to have strong earnings, it could actually be a little lower, and you could still expect, very positive returns over the next 5 years. But just wanted to point out. Sorry, go ahead.
No, go ahead, Cody.
Just wanted to point out the difference from, the fall of 2022 when everyone was getting concerned. Do I get out of the stock market? Do I go to cash? That's actually when you can make the argument that, you should put your money to work. Now we're not saying to get out of cash. Get out of the stocks and go to cash. We're just saying potentially the expectation should be a little lower if the earnings aren't as strong as what the estimates are.
I just remember that Bloomberg headline from 2 years ago. This is going even further back, but 100% chance of recession. When everyone says there's 100% chance of recession, that was literally the bottom of the market. I think it was within 5 days. And so it just goes to show when expectations are low, when sentiment is low, expectations should be higher.
Yeah.
Expectations are higher. it's that it's counterintuitive, but it's a really important part of investing.
Yep. Yeah, like what Warren Buffett said, be greedy when others are fearful.
Mm-hmm.
And we're not saying, obviously, you should have gone all in stocks. You want to make sure you have your right allocation, but that's a good point. So one other slide we want to bring up, which I'm sure everybody's seen on the news, is looking at potentially overexposure in different stock markets. So, or different benchmarks. So the blue line is the US large cap growth. The black line is US large cap, and the red line is US value. As obviously everybody can see, since the, 2000 teens, we've had a vast run up in large cap growth. You can actually see the valuation, the weight of the value stocks went down. And what this is saying is the weight of the top 10 securities in these different indexes. The reason we brought this up is it's very important to work with your advisor to make sure you understand what you own. So we have clients, obviously, and prospects that ask, what about NVIDIA? What about Apple, Google, Microsoft? And this is why it's important to break open the funds that you own to know if you're potentially overexposed, and if you're just in US large cap growth, or if you're just in US large cap, just making sure you know the allocation that you have to some of these individual stocks that you may want to get into.
Yep.
And to recognize the impact that those stocks could have too. I mean, as those stocks have been running up, great, it's pulling the whole index with it. But if they sneeze, if anything, happens to those front runners, you're going to feel an immediate impact within the index.
Yeah.
Mm-hmm. Mm-hmm.
And
I'll never forget. Even coming back even coming back to this peak back in, the peak back in 2007, 2008, when value was that much higher than growth. I remember the CEO of Citigroup said, you need to keep dancing while the music is playing. And when the music stops playing is when things fell off a cliff. And I just think, the music keeps playing for a little bit, but then the cycles change.
Yep. And then one other chart we wanted to bring up after this is going over, obviously everybody sees how good the top 7 stocks have done inside the US. What we're looking at here is year to date, again, as the close of July, actually middle of July, what the best returning stocks have been around the globe. So you can see US has 11 of the top 50 stocks so far year to date. India has 11, China has 9, South Korea has 7. So just to point this out, that US does not have a monopoly on the best performing stocks year to date, and obviously won't continue having that going forward. So this is why it's important to have that diversification. So
out of the 50 stocks, 39 of the best performers were not in the US.
Correct. Yeah.
I mean, I think that is a pretty good rationale not to ignore the rest of the world.
Yeah. Yeah. And I think we went over that in a different chart on our last quarterly market update. And it was around 80%, which right around is 39 out of 50 on an annual basis outside the US perform better than the US on an individual stock basis.
But interestingly enough, I remember we don't have that chart up in front of us right now, but the concentrations outside of the US are not as strong either. So even though they have some top performers, they have some other strong companies that are more broadly providing those returns across the international and emerging market indices.
Yep. So one other chart we wanted to bring up. Obviously, politics has been top of mind for a lot of people. We're going into obviously a huge election season here inside the US. We just wanted to bring up a chart, obviously going back to the 1960s. And the one thing I would say, just the preference is what stands out to you guys. Everything is up to the right. Sure, you have little dips here every once in a while, but honestly, majority of it is not because, George Bush was the president. It's because the economy was slowing down. So what we're focusing on is what's going to change depending on who's in office. Are they going to make changes to the tax laws? Are they going to make any other changes to potentially retirement planning? That's why it's important to work with a financial advisor and, get ahead of potentially any changes that, a president or the Congress is going to make. Anything else stand out to you guys on this chart? Just going over, Republicans versus Democrats, or just the long view?
No, I think it's a good visual to remember that there's not really a correlation between politics and the markets and the economy necessarily. But it's true. Things like Secure Act 1 and 2 that came out in the last 4 years, for many of our clients, the consequences and implications of the changing IRA rules have as much impact as things that are happening in the markets. It's caused us to do a lot of planning and think about taxes in a state and all those other things. So we're looking at more policy than politics, and sometimes those two are very different.
Yeah, good point.
I think, like you said, the bottom line too is stay invested, and I wouldn't discount periods like the George Bush administration, where we were basically negative, or it was the lost decade, or we had like a lost decade of U.S. returns. That was a huge wealth building opportunity for people,
Wasn't it, though?
because they were investing into those lower numbers, those lower rates. So when things took off, they had far more shares that could participate than they did beforehand.
Mhm.
I mean, those volatile periods are just as important to portfolio growth as the up years are.
Yeah, very true.
Great. All right, we're going to pause there. If you have questions, we're going to stay online. We're at the 30-minute mark. We're going to stay online for a bit. Just answer any questions that you might have. It's open season. If you have, whether it's planning, investing, the political, economic environment, happy to answer anything that you have. But while we're sitting here, Katie, you brought up that article that we shared. Katie just got back from her sabbatical, so she was gone for 5 weeks. So if you guys haven't seen her in a while, neither have I. So but there was that article in the New York Times about it started out, the premise for the article was, for a certain type of money professional, there's a particular question that is decidedly unwelcome, and it tends to come up in a variety of social settings. Got any hot investment tips? Katie, what do you think when you hear that?
Answer, no. Honestly, I think, it's good. I understand where that question comes from. It's the hot investment tips, or the other one that really kind of gets to me is, hey, what did the markets do today? And we've talked about that before, but I so appreciated this article in the New York Times, because it acknowledged what I felt like it was speaking directly to me, and saying, investing it's for some people, for even some advisors, it's a tool to help you reach your goals. And the real satisfying work is figuring out those goals and figuring out how everything fits together. It's not necessarily diving into the day-to-day and getting excited about the day-to-day. But anytime I hear that, I think to myself, there's no one answer. There's no one, hot stock tip that's going to get you to where you want to get to. It's the slow and steady discipline that's required, I think, along the way.
I couldn't help but think of how much ink is spilled every day in publications on just what's happening today. It's why I don't read the Wall Street Journal until the end of the day, because at the beginning of the day, like, we think this might happen. Well, did it or did it not? That's all I really care about. But how much ink is spilled every day on just the minutia of the day-to-day markets, whereas just read this one article and then go about your life. That's what I thought when I read it. Is just, this should tell you, just read the article, go about your life, and have a good plan. Just have a good, strong investment thesis. Comes back to that Callan chart, Sean. Just own some balance of the things. Have the courage to stick with it, and it works long term, and it has worked.
Yeah, and then as things change, obviously work with your advisor to make tweaks when necessary.
Yeah,
because things obviously are going to change. When we do a financial plan, as we tell our clients, we want to make sure we update this on at least a yearly basis, because things are going to change going forward.
Yeah. And it was interesting in the article. It also, we all went through a behavioral coaching session earlier this year with a group called Shaping Wealth. And we talked about kind of the behavioral coaching and how to approach client service and everything else. And it quoted, Shaping Wealth is a group that was founded by a financial analyst, a clinical psychologist, and a neuroscientist. Well, the clinical psychologist, Joy Leary, she was quoted in the article as coaching one of the advisors to say, don't worry about this stuff. And just, be confident enough, be bold enough to focus, client energy back on the right things.
Yeah.
And oh, by the way, that might be the healthy approach.
Mm-hmm.
Like that's the thing that I really appreciated about it too, is once again, going back to, if you were constantly focused on what's happening every minute of the day and every little ticker symbol, that just raises levels of anxiety. I mean, if you
Yes.
can kind of tune that out and say, that doesn't matter to me as much as I know that I'm positioned for the long term. I know that I'm working toward my goals. I'm controlling the things I can control. I mean, those are all the good like habits and discipline that are going to get you to where you want to be and allow you to be kind of humbled along the way
Yeah.
rather than
Yeah.
being knocked up and down. And yeah.
No, I know. I mean, one of the big stories of Q2 was, where do I have exposure to NVIDIA, for example? Just expending energy thinking about that. And there was an article in the Wall Street Journal last month about how active stock pickers, people are running mutual funds who are trying to, beat the market by picking the right stocks. It talked about how so many of them were underperforming because in the effort to pick the right stocks, they didn't pick NVIDIA. They picked all the other things and they were lagging so far behind. So it's just like, you think this is their paid job to try and do that. And if you miss out on those things, rather than just, taking a broad approach and capturing the market as it is.
Yeah.
Right.
What were you gonna say, Katie?
1,000 stocks in the index to choose from, and only a handful of them are going to give you those skyrocketing returns. I don't want to be the person to try to guess which one of those handful of stocks.
Right,
Yeah.
right. Which comes back to the hot investing tips. If we do this for a living and we don't know, the average Joe down the street, the odds are they're not either. So
Yeah. And then you have years like 2022, NVIDIA was down 60% in 2022. And then just think of the run they've had since then.
Yeah, can you stomach that?
Yeah.
Right. So anyway, we're kind of going off a little bit of a tangent here, but these are the types of conversations though that we do have with clients and that we welcome, with individuals. And if anybody's thinking, am I on the right track? Is this something that I need either a second opinion on, or I just, I need a little bit more maybe than what I'm getting right now. A little bit, I need more eyes on the big picture. We definitely welcome those conversations, and we just really appreciate everybody joining us for our live market update. And we'll be back again in October. So we do this quarterly, and it's just an opportunity for all of us to learn from one another.